Today's episode is brought to you by Mazars. SoundCartel. Who would have thought the property market would take off like it has? Great news for sellers, of course, and for buyers if they got in before the sudden upswing. But what about people trying to get into the market now? From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. The bank of mum and dad could be a help for some, but what do the banks really want these days to get loans over the line? And what about other parts of the market, as buyers, sellers and investors all look for the best deal in this huge hot property world? Nic Don has been helping clients do property deals for many years. He's a financial planner, a mortgage broker and a real estate agent, and he's won many awards within the financial services industry for the work he's done over the years. He's also a much sought-after speaker, and he's managing director of Odyssey Financial. So, first question for Nic, from Nick Schilberger, what's actually been happening growth-wise in property in 2021?
Just looking at the different states, starting off with Sydney, we're up by 19%. Melbourne, 16%. In some areas, especially coastal areas in Victoria, 25 and 30% increases. Brisbane, 16% growth and growing further. A lot of Victorians and Melburnians are moving up to Brisbane for weather and other reasons. Adelaide has seen 13% growth in 2021. Perth, 19%. They've been coming off a low base for quite a few years. Canberra, 16%, as well as Darwin, 16%. So it's been an absolute massive turnaround from a lot of the doomsdayers who were sprouting that the whole economy and the property market would be dead for many, many years. It's been a massive turnaround.
Is it sustainable?
Yeah, I think it is. There's no reason why it's going to fall off the cliff. There's no reason why interest rates are going up. They're not going up anytime soon. Inflation isn't there. Longer-term fixed rates have just started to sneak up a little bit, but the RBA has come out and said that they're not touching the official rate for at least 2 to 3 years, and that controls your variable rate and your shorter rates.
Before we talk about property more generally, there's one group who now feel that they're being priced out of the market, and they're the first home buyers. Tell us about this group and what governments are providing as far as incentives.
Righto, well, this is seriously where we've had our highest demand. Your first home buyers, they've been sitting on their hands for quite a while, but I think over the last 12 months, they've sat down, had a look at their finances and expenses and budgets, and they really don't want to miss out. They want to get their foot on the property ladder. Ones who have been renting can probably own and buy their own property at a lower cost than what they've been renting at. Ones who've been living at home with their parents, especially over COVID, have probably wanted to escape and get something for themselves.
Their parents might agree.
Exactly right. So what the governments have been doing, and the federal government budget just recently announced, they're offering or providing an additional 10,000 places for the first home buyer scheme, where a buyer only has to come up with 5% and the government guarantees the balance of 15%, making the loan only 80% so they don't have to take mortgage insurance out. The federal government also is releasing 10,000 additional places over the next 4 years for the single parent guarantee. This is where if you're a single parent, you've only got to place 2% deposit down and there's no insurance. And then you've got the state incentives, and every state has slightly different for the first home buyers. And if you look at what they're trying to do is to reduce the stamp duty costs for first home buyers and also provide other incentives if it's a new property build. For example, in Victoria, there's no stamp duty if you're buying up to $600,000, and then it's staggered up to $700,000 and over where you're paying full stamps. In Queensland, there's no stamp duty for under $500,000 purchase. In WA, no stamp duty up to $430,000 purchase. In Tassie, you get a 50% discount for properties up to $400,000. So the governments are doing absolutely everything they can to encourage people to get into the property market, which is fantastic.
That's great, but how easy is it to get banks over the line at that end of the market, or the market overall for that matter? What are the banks asking for these days?
Look, we've got a bit of a saying in our office, and they're asking for everything plus a vial of blood. They're getting ridiculous. The credit requirements, the policy requirements. And this is where, within our broking division, we've found a surge of inquiries because dealing with a bank directly would be a nightmare. First of all, they're looking at every expense line by line. So you've got to actually provide your monthly living expenses. And this comes down to how many lattes you might have a week, or there was an article 12 months ago about, your Saturday morning avocado
Smashed
on toast.
avocado, yeah.
And credit officers are going seriously through credit card statements line by line, savings statements line by line. They need every bank statement that you've got for the last 12 months to assess. And this is for a first home buyer plus also a second home buyer and a upgrader. Genuine savings proof. They need to see where you've actually saved your deposit. And if you're a genuine saver, you get one type of interest rate. If you're not a genuine saver, your interest rate's a little bit higher because it's a higher risk to the lender. We've also got to provide exit strategies. So if someone's applying for a loan and they're 40 years old and they've got a 30-year loan, that means that the end of that loan is basically after retirement age. So believe it or not, we've actually got to provide an exit strategy to the lender, showing them how this borrower is going to get out of this loan prior to 30 years. So the banks are certainly asking for a lot more, and their service times have blown out substantially.
Do you receive many inquiries from parents, the bank of mum and dad, to help secure a loan for their kids? And if so, what do you recommend? Gift, loan, guarantee, or are there other options?
Yeah, great question. The demand from our existing clients that have got children, we're getting phone calls every day about how they can help. Back 5 years ago, the only way parents could help would be to maybe give their kids a gift and say, righto, here's 10% or X amount of dollars, and you might be able to avoid mortgage insurance, or here's your deposit to be able to show the lender, etc. And then a lot of parents were lending their children money. But when they apply for the loan, the kids have got to actually declare that they've borrowed money from mum and dad.
Another liability.
So, righto, how many years are you paying off mum and dad, etc., etc. So once again, the loan is rejected. Where the banks have come up with some fantastic policies, it's called a family pledge loan or a family guarantee or a family security. And this is where mum and dad have got equity within their home or their holiday house or an investment property, or their uncle might have the same thing, or other family member. And the person borrowing can take 80% against the property they're buying, and they can top up that loan by another 5, 10, 20% against equity against a family member. And by doing this, they're avoiding mortgage insurance. So they're saving $5, $10, $20, $30,000 insurance, and they're able to get into a property well before it would take them time to actually save that deposit. So that's been fantastic, and we're doing that with a lot of clients at the moment.
For the rest of us, where do you see the biggest opportunities?
Well, looking at buyer types, your downsizers, they're taking advantage of a hot property market. They're identifying what equity they've got and they're downsizing, but also the ones getting towards retirement are taking advantage of what they call the superannuation downsizer contribution. So they're actually downsizing their property, pulling cash out, and they're able to top up their super. So they're actually getting a double bonus. Investors, great opportunities there because there's a huge rental demand around Australia for the right types of properties in the right locations, and the larger properties, larger apartments, townhouses, etc. And with rent yields at say 3, 3.5 or 4%, and borrowing at in the low twos, properties are positive cash flow from day one. Great opportunities, I think, regional and coastal areas. We've seen, the huge growth in values there. But I think with COVID, we've identified that we're able to work remotely, and a lot of people are moving to regional areas. I was looking at a report yesterday, Ballarat. For every vacancy for rentals, there's 60 applications. So a lot of investors are buying up in Ballarat. In Newcastle, which is 120 k's north of Sydney, tenants are signing leases, properties sight unseen. They're just grabbing them up front.
Desperate.
They're absolutely desperate. Perth, they're looking at 15 to 20% increase in rents. So there are some fantastic opportunities, I think, for owner-occupiers and investors.
What about sellers? Getting quick now while the market's hot?
I think a lot of people are thinking that. However, we've got spring coming up in 4 or 5 months' time. It is going to be a frenzy over spring. But the RBA's modelling of property growth sees that growth is going to continue through this year, obviously, but also 2022, they're expecting 8% growth around Australia next year, and then even into 2023 at 8% also. So over the 3 years, they're expecting 25% growth. So I don't think it's a case of getting in before the market cools off. I think it's going to keep going along very, very strongly. The RBA is not going to jump in and slow things down. I think what may happen in maybe 18 months, 2 years' time is APRA, which is a governing body, may come in and pull a couple of levers to try to slow borrowing down a little bit. And they're the ones that say to the banks, look, pull up on your policy, don't lend 95%, lend 90%, etc. But for the next couple of years, I don't see any slowdown.
Apart from the banks not lending the money.
Exactly right.
Nic, where do you see the biggest watch-outs for buyers, sellers and investors right now?
I think the key is, with low interest rates, don't overcommit. Work out your budget pretty carefully, and you can be guaranteed over the next 20 to 30 years that interest rates will be higher than 2%. The average interest rate since 1900 is around about 6.5% to 7%. So we are way, way less than that. So I think budgeting, you need to be looking at maybe 4 or 5%, and if you can afford it at those rates, jump into it now. But yes, don't overcommit with finance. Investors, I've seen a lot of investors get hurt because their interest-only loans converted to principal and interest. And at that time, 5 years ago, they could just go back to the bank and say, look, I just want interest only again. That doesn't happen now. If you've been with and each bank has a different policy, but some banks, if you've been interest only for 5 years, you've got to convert to principal and interest. And the only way to get back to interest only is to refinance.
And that's not easy.
No, they might be between jobs. I've got clients now that their serviceability, one partner might have dropped their wage or be off work or whatever, or rental may have stopped, or I've had some clients see that their existing loan was on COVID repayment holidays. Can't refinance for 12 months. So once again, it's important to look at budgets very, very carefully.
That was Odyssey Financial Managing Director, Nic Don. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow @BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.